Hi, everyone. Happy New Year. And on behalf of all of us at Allan Gray, we wish you and your families a great year ahead. And welcome to our first investment update for the year. Instead of our usual format, we're making it a bit harder for Duncan this year. I'm going to be asking him a few key questions that actually our investment team are actively debating at the moment, as they're thinking about how best to position their portfolios. And actually, these questions, I imagine, are also front of mind for all of you. So with that intro, and before we get on to kind of some of the forward-looking issues for the year, Duncan, the first question that I thought we should chat about is just a bit of a recap on 2025.
Thanks, Tamryn. Hello, everyone. I was proven to be very cautious last year. If we look at the returns, actually very high absolute returns for the market. The all-share index returned more than 40% and the all-bond index returned more than 20%. But what makes that more interesting is that the rand actually strengthened 13%. So if we put sort of the market into dollars, the Aussie did over 60% and the All-B did 40%, and that's almost twice the NASDAQ. So that's not something you would expect. But I think what's important, we speak to a lot of people and they're kind of like, well, there seems like a disconnect between what's happening in the economy and the news and how come the stock market did so well. And I think what we've got to realize is the returns were very narrow. And what do we mean by that? The returns of the index, a significant portion of those returns came from the precious metal shares. So in other words, platinum and gold mining companies, and then sort of Naspers process, given the size of it in the index, Naspers was up over 50% itself. So a lot of the other shares didn't do nearly as well. And it's quite interesting because if you went back and you said, Duncan, would you be happy if a lot of your shares returned 20 or 30%? I go, that would be fantastic. And a lot of them did, but then you did half the market. Right, so it was a very narrow return and very focused. I think that's something for people to keep in mind. And that's not just South Africa. If we look at the US market, there's obviously been a lot of talk about the concentration. So the top 10 shares making up almost the highest percent of the index, sort of going back many decades. And that we've seen that in other sort of countries as well. I think the second major sort of interesting point of the year, and something we've been talking about and our colleagues at Orbis, is that investing in the rest of the world outperformed the US for the first time in many, many years. And it's been quite a rare occurrence for the rest of the world to outperform the US. And that includes markets like ourselves. And I think the best performing market of reasonable size was South Korea, which was up over 70%. And then just to prove the disconnect between sort of economies and markets, even Europe and the UK, in which most of the economies like France and Germany and the UK are really in the doldrums and the politics is really messy, they're all trading at new highs. The third sort of trend I wanted to talk about was precious metals, and that's obviously quite important to South Africa. I've already mentioned the gold and platinum. Silver led the way. Silver is trading over $90 now. To give you an idea, it was in the low 30s at the beginning of 2025. We know gold's making close to all-time highs, and that dragged up the platinum group metal mining prices as well. And that's quite important for South Africa because gold and platinum are big export earners for South Africa. The area feels a bit frothy for me. It's not often you see gold and platinum on Bloomberg and CNBC and in all the magazines. But it's been good for the portfolios. And then just the last thing I want to mention was the really good, strong relative performance of our colleagues at Orbis. So producing really strong alpha over the last 12 months, both in the equity-only portfolios and in the asset allocation portfolios. But just to remind everyone, the rand strengthened versus the dollar. So when you translate the Orbis returns into rands, they're actually much lower than you got on South African assets.
Okay, so then it was narrow market but strong returns locally and offshore, rest of world outperforming the US, precious metals, and overall a pretty good relative and obviously absolute performance. So if that was 2025, now let's try and look ahead to what we think will kind of drive markets, but perhaps more importantly, how these themes will influence how you're thinking about the positioning. And so I thought about four. The problem with themes is that Duncan and I were saying earlier, they're very interrelated. So the four themes that I thought would be useful to talk about is one, our kind of outlook for SA assets, to sort of talk a little bit then about, the weakness of the US dollar, and the kind of the link to whether or not, as you were kind of alluding to earlier, this precious metal rally is sustainable, the role of geopolitical divides and conflict, and then finally it's the kind of the topic that is equally shared on earnings calls and dinner parties, which is AI. So let's start off with SA, because that's what we tend to think about and care about the most. And as you said, there was this disconnect between the performance, albeit it was quite narrowly concentrated, and the underlying prospects. So how does that influence how you're thinking about it going forward, and have returns just run ahead of where the truth is sitting in the economy?
So I think we've written about this recently, and it's very important, is the all-share index is not representative of the South African economy, nor the performance of the South African economy at an index level. And the index has changed significantly over the last few years. Most people think they're buying Richemont and Anglo-American and British American Tobacco. You're not. You're buying Naspers plus the precious metal shares. So precious metal shares now make up 25% of the index. So when you're asking, what do you think about South African assets, a lot of it has to do with how you think the gold and platinum prices are going to behave, and that's inherently very difficult. If we kind of look below the surface, in the last sort of couple of months, we've actually seen a broadening of the market, both here and overseas, which means more shares are starting to do better. And we've actually finding some very interesting opportunities in the South African consumer space, where we can take some profit out of the precious metal shares and then sort of move it into some of the South African consumer names. Why is that? Well, many of them have struggled. So if you go and look at their share prices, that's far more sort of reflective of how the South African economy has behaved. But thinking about it, high platinum and high gold prices are very good for the South African terms of trade, especially at the same time we have low oil prices and a strong rand. So we could see the economy getting better, but unfortunately we need sort of 3 to 5% growth. I always get very unhappy when people stand up and applause 1.5% sort of real growth.
It's off a low base.
Yes, and so we are finding opportunities there, because there's been this weird disconnect in the local market where, as I mentioned, the all bond index has had an incredible 2 years. Part of it was a very cheap starting point, but normally South African Inc. shares, those are shares that earn most of their profits in the South African economy, they tend to perform strongly when our bonds are performing strongly. And that's kind of not happened. The sort of bigger shares have outperformed while the bond market's been strong. So either the bond market's wrong or the South African Inc. story is wrong. I think it's a mixture of both, because a lot of fund managers were very underweight gold and platinum, so you have to fund it from somewhere. And the way you do that is you sell your South African retailers and your South African banks and your South African food producers. The other thing that happened is in the bond market, in the last few months, we've had some of the biggest foreign net inflows of all time into the South African bond market, just actually dwarfing the issuance of the government. And I think for foreigners now, South Africa is quite a low weight in the emerging market index. And it's easier for them just to buy a government bond that was yielding 12% rather than going and spend weeks and weeks of work trying to understand the intricacies of various smaller South African companies. So I think that's going to be interesting. And on an overall index level, we can look at all the companies we analyze at Allan Gray, put the returns together, and see what kind of return do we get for the South African equities. And it's pretty low. It's below 10% at the moment. And that number was sitting at 15, 16 sort of a year ago. But within that, we think there's a lot of different pockets of value. But the biggest call by far is going to be the precious metal prices. And you mentioned the dollar debasement trade there.
That's my next question.
Yeah.
No, you carry on.
Yeah. So we were thinking there, and what does that mean? It means, America, their asset markets have obviously dominated the world for many, many years. And so America imported more than it exported. That means it's got a big trade sort of deficit, and it's got a fiscal deficit at the same time. The mirror image of that is obviously, if you're taking dollars, you have to put them somewhere, and people put them back into American markets. And basically with the tariffs and Liberation Day and the American governments and the US Treasuries sort of wanting to narrow those deficits, it's basically saying, we don't want your money to come to America. And that's what people mean by the dollar debasement. And it only just takes sort of 10% of those flows to go somewhere else. I mean, we all have seen those crazy stats where Nvidia is bigger than most countries' entire stock market. So if that just all of a sudden goes to emerging markets or Europe or South Africa, it makes a very big difference to prices. And sort of the second bit of the dollar debasement sort of trade is, obviously you're running this huge fiscal deficit. Most big countries around the world are, but America is absolutely staggering in size, and it doesn't look like it's going anywhere. And so how do you fund this? If people are not going to be buying American bonds, well, one way you fund it is the Federal Reserve Bank starts doing quantitative easing again, it starts cutting interest rates, and that will lead to a weaker dollar. So now you're a central bank or you're an investor offshore and you go, do I really want my money all in dollars? And by the way, Russian central reserves, which were in US treasuries, were frozen by the West. So they go, okay, I better have some of my sort of reserves in gold. And then, the price starts to run and it makes it, and then you get a lot of the retail investors coming. But it'll be interesting to see if that carries on next year.
So if you think about that, though, from the perspective of a South African investor, over many years, this has been a one-way bet, the rand versus the dollar. And so how would you think about the risk of a continued dollar weakness as you position the portfolios going forward?
Go on holiday to New York. It's probably the first thing that comes to mind.
No, glass of wine will be cheaper for the first time in a while.
So just to put it in perspective, so the dollar has been weak against almost all currencies other than the yen, right? So the dollar index went from about 111, 112 to about 99, where it's sitting at the moment. So it's not just rand strength, it's also dollar weakness. I think what we've spoken about quite a lot is, the world, we'll maybe come back to that, has changed quite a bit since sort of 2020. It's a theme we've been talking about. And sort of one of those themes for a long period of time was the dominance of dollar-based assets, and that might have changed. So that's just something to think about. The flip side of that is, other than some of the big Chinese tech companies and perhaps one or two companies in Europe, where do all the innovative companies come from, and where all the things we use every day, mainly in tech? Well, they all come from Silicon Valley and America. So as Warren Buffett always famously said, it's very dangerous to bet against America, but it's probably just the size of the allocation is going to be reduced.
Okay. So true, it's dangerous to bet against the US, but I was reading something earlier about the reason why emerging markets often trade at a discount is because people see government policy as being unstable, and there's no shortage of news flow at the moment to maybe make the same comment about US government policy. And so that brings me to kind of my third theme that we've been talking about, which I don't like to give you too much credit, but it's definitely one you've been talking about long before it became mainstream, and that's this increasing divide between West and East and the rise of geopolitical tension and tariffs being a tool in this, rise in nationalism being a feature of this. So when you look at that, and there's a lot of news flow, what do you think are the most important things that one, as an investor, one should factor into?
I think the first thing sort of to notice, because often you don't see it happening, is, especially for people of my young age, we've grown up in an era of globalization, of increasing trade flows, of alliances, peace. But when you look at history, that's not the case. That's the rare occurrence. It's actually normally, and I've heard like two phrases which I enjoy using, which I think describe it well. So the one is said by a good friend of mine, your portfolio might not be interested in national security, but national security is definitely interested in your portfolio. The second one is values are not universal, power is. And I think that's what's happened in the world. You kind of see the world, as you said, splitting, where China wants to dominate its sphere, America wants to dominate the Western hemisphere, and sort of these days of sort of alliances, I think they're pretty much over. And if you look at the speed at which the Trump administration is moving, I think a lot of people, me included, don't think a lot of what they're doing is wrong. It's just the way they're doing it, right? These imbalances across the global economy, the things that have built up, they needed to be corrected. Now, how you correct it is perhaps more complex, but you can see there's sort of a plan behind the madness if you look there. And I definitely think one of the things that's in there is a word that gets used a lot when speaking about geopolitics now, which is resilience, right? You want to be resilient. If you go into a pandemic again, you want to be able to access the medicines. You want to be able to access things. We've seen with the rare earths, America's got all this great technology, but all the processing sat in China. And if you're going to go to war with China, you can't have all those capabilities sitting in other countries. Yeah. And if you actually think about it, people think Greenland's sort of crazy, but if you actually look at history, Theodore Roosevelt tried to buy Greenland, as did Ronald Reagan. So, it's not just these new things that come about. But so I think it's just going to be a world like that. And how do you put that in the portfolio? We just got to think about sort of geopolitical over-risk. But more importantly, there are definitely going to be some companies that benefit and some companies that might get stuck, including countries. And that's one thing you want to think about. Give you a good example. Fortunately for the portfolio, you would have seen, Rio Tinto, the large British Australian mining company, has made a bid for Glencore. And we've seen we saw Anglo American merge with Teck Resources. We saw BHP Billiton try to buy Anglos. Why is this? Because everyone's realized we need access to these commodities. And these commodities are in finite resource. We want to make sure we control access to those commodities rather than, I'm just going to use the word, our adversaries. But if I bring it back to South Africa, we've focused a lot over the years on the concentration of the South African stock market to China, for want of a better word, through the mining companies, through Process, through Richemont. And the biggest geopolitical risk for the South African market would be if China invades Taiwan. And now, we're not geopolitical experts. Xi did kind of hint he wants it done before 2027. After seeing what happened in Venezuela, where the Russian and Chinese, as far as I understand, defense didn't work against the US, they might be having second thoughts. But all the kind of stuff we read, China's preparing for an invasion. Whether they do it or not, I'm not sure. And that could have quite a big effect on our stock market.
Okay, on that somber note, I'm going to move on to the final dominant theme that it would feel remiss not to talk about, and that's on AI. And it still feels like a lot about AI is still unknown, but some things have become clearer over the past year. What do you think are the most important things we've learned over the past year or two, and what are you specifically looking out for?
Yeah, so try to stay humble when it comes to AI. I still write my presentations with a pen. But, if you listen to the real top guys, they'll say they're probably between 500 and 1,500 people in the whole globe who really know what's going on at these large sort of artificial intelligence companies. So I think, the obvious one everyone always sees is, the large language models. And I think those are going to come into more prominence. Why? Because it looks very likely that OpenAI, Perplexity, and SpaceX are going to list next year. But that's not really what AI is about. Dear AI, please plan my holiday for me. When we look at it, the big sort of things that are coming that are easier to see are one, sort of the capex of the hyperscalers. So that's Microsoft, Alphabet, Meta. They are spending next year between $350 to $400 billion in 1 year on capex, which is forecast to continue. And that doesn't even include OpenAI's capex. And those are big, big numbers which are driving part of the US economy. But investors, I think, are increasingly going to ask, well, where are the returns from this money? Like, what revenue are you going to generate? And it always seems kind of obvious because, you read emails just about some of the amazing advances taking place in medicine and in cancer cure and all these things which has been driven by AI. But still, where's the revenue going to come from? So I think that's going to be one of the big things for artificial intelligence next year. Where Orbis have done well, and I think where there was a sort of a second theme was obviously these data centers are massive. Some of them are like 1 gigawatt. So guess what? You need chips in there, and that's why NVIDIA is the most valuable company in the world. And fortunately for us in the offshore portion of the portfolio, Orbis owned Taiwan Semiconductor, SK Hynix, and Samsung, and those shares have all done really well for the portfolio. And of course, those data centers need electricity, they need water. Do you want all these big buildings in a neighborhood? So I think that's sort of one sort of theme. But I think where the market's increasingly looking is saying, okay, like we all know about that. Where we're going to move to now is who can benefit from AI. And the people who can benefit from AI, fortunately or unfortunately, are labor-intensive and process-intensive businesses. And the info is very mixed. I've seen surveys where chief financial officers say, we're not getting any benefit from AI. There's no cost savings. And then you see other ones that go, we are going to operate with 12% to 15% less employees. We just haven't told them yet. And you can see it showing up sort of in all the data in the UK and the US that younger people out of universities are finding it harder to get jobs. So I think it's going to move to that sort of efficiency phase. I think the most interesting thing for me is sort of on the regulation.
Yeah.
Like, what do you do? If America is going to put in guardrails, which all of us would want, what happens if China doesn't? So I think that's going to be sort of a super interesting thing, but something that's going to dominate news flow and markets for probably the next decade. Interestingly enough, the last capex boom we had, which was the telecoms boom in 99 to the year 2001, none of the companies that were the big names then actually were the people who made the money. It was ironically Meta and Alphabet and those type of companies who made the money.
So we've got to wait 5 years to find the winners.
Yeah, it's not clear. And you never know whether you're going to wake up and artificial intelligence jumps another sort of 20%. And just to give an example to our clients about why it could be difficult, I was in London and I attended two sort of presentations by the two leading quantum computing companies in the world. I won't get into quantum computing because it's quite complex. There are lots of people who are big skeptics, but if it works, that's bigger than AI. And there's no such thing as sort of secure data. It just could be a massive change. So that's the tough thing about sort of where we're going technology at the moment, is it's not clear. We're not at the cutting edge, and something could just pop out of left field like DeepSeek did last year, and we saw what that did to some of the big US tech shares.
Okay, so we've run out of time, and I just want you to wrap up with 2 points, please. So the first is you take kind of the themes that we've discussed and kind of where we started off the year in terms of valuations and last year's returns, and how are all of those influencing the portfolio positioning, both local and offshore. So if you could just summarize, how you're thinking about that or how you would characterize it, and then maybe end off with just one key takeaway that you'd want advisors and clients to take away.
So I think the portfolios are not positioned very differently sort of from last year. As the rand has strengthened, we've actually increased the offshore exposure a slight bit. And Orbis's equity portfolio continues to look very, very different from the index. One thing I did want to say, which is kind of maybe coming towards the end, was, again, just to mention what I did at the beginning of our chat, that the returns this year are well above what we would expect through the cycle. And normally what that means is the shares you've owned, you should be looking to rotate them into other areas. But, you need to be humble in years like this and say, beta or the market did a lot of heavy lifting, right? Even though Orbis were able to add some extra value. And as I mentioned in South Africa, we're always looking at some of the shares that have done well and whether we're going to rotate some of that into places where we can find value. And the one thing I've taken from the last sort of 3-4 years, if you remember what a terrible year 2022 was, and now we're just sitting in 2026, is I fundamentally believe the world has changed. It's changed a lot from the WTO, from globalization, from peace. But what last year shows is you can still find amazing opportunities to deploy capital for your clients.
Okay. Thanks, Duncan. And thanks, everyone, for listening to us. We look forward to chatting with you all in the weeks and months to come.